We continue with our discussion on Unit 1 of Financial Reporting and Analysis. And in this particular section, we're going to talk about the profit and loss account, or what is also commonly known as the income statement for any company, right? So the income statement and how does that kind of build in is what is going to get covered in this particular section. Now, what do we mean by the income statement? Profits are a measure of the company's well-being and perceived value that it kind of generates or creates, value addition by the customer. By getting a customer, what kind of value the company creates is what comes under profits. The P&L account is a sort of a report card of the financial performance of a company in a particular period. Remember, this is a period statement, and unlike the balance sheet, which is the statement as on a particular point of time, this is not on a particular day, but it's for a period, for a year, for a month, for a quarter, for 6 months, right? Profit and loss account is also known as the P&L statement or income statement. The term earnings, net earnings, profit, net income are all used interchangeably, right? So profit, net income, earnings, etc. are all interchangeable in the context of our understanding, right? Now, what are the various views of profits? Now, first, let's understand that when the company makes some sales, those sales are called as revenue. When you subtract from the revenue all sorts of costs, what is left is called as net profit or net income, right? These costs could be operational in nature. These costs could be financial in nature. When we say these could be interest cost or something, or these costs could be taxes in nature, right? So there could be any of these costs that could come in when you are creating the income statement for any particular company, right? Now, typically, if we remember, we said that the balance sheet is as on a date, and there's another balance sheet as on date. So let's say this is balance sheet 1 and this is balance sheet 2. From going from point A to point B, point B1 to B2, the company will undertake some business activity during the year. This entire business activity, what is the remuneration because of that? What money do you make and what money do you lose in this process is accounted in the profit and loss account statement, right? Now, so essentially you will book whatever sales you have done, you will book whatever costs you have taken, and then try and find out whether there was a profit that was made. If there is no business activity during the year, then the balance sheet will be the same as the balance sheet last year, right? There's not going to be any difference in that. Now, when you look at profitability, there are multiple views of profit which come out, right? And when we look at more examples in detail, this will become simpler for us to understand. When you take a company's sales, which is nothing but revenues, right? And you subtract from the revenues only the cost of the product that you're selling, right? So if the company is selling, let's say, a car, then only the raw material and the cost of salary, etc., that has gone into making that car is removed. That's called as cost of goods sold, right? What do you mean by cost of goods sold? So let's say I want to sell a laptop. All the raw materials that go into the laptop plus the specific wages and salaries that go for people who are building that laptop, the time for which that salary is paid, plus any kind of electricity that is consumed in building that laptop, that all goes under cost of goods sold. When I subtract this, what I get is what is commonly called as gross profit, right? That's what is called as gross profit margin. Now, there are other operational expenses that could be there, right? Salary for other people in the business, marketing expenses, selling expenses, all these other operating expenses, when you subtract them from the gross profit, you get what is called as earnings before interest, taxes, depreciation, and amortization. We're going to consider depreciation in more detail in another section, but basically, this is the core operating profit that the company has generated, right? It's called EBITDA, earnings before interest, tax, depreciation, and amortization. That's what is called as EBITDA, right? From EBITDA, if I just subtract depreciation and amortization, this is a non-cash expense. What do we mean by a non-cash expense? We are just doing an accounting treatment for something, right? As I said, we're going to discuss about depreciation in more detail in subsequent sections. For the time being, just park it here, leave it here, right? What we get is EBIT. Remember, we have removed D and we have removed A. What is left is earnings before interest and taxes. Then you pay the interest. Remember, interest is tax deductible. So you first remove the interest, and what you get is profit before tax or earnings before tax, EBT or PBT. On this, there is a tax. So you remove the taxes there and you get net profit or profit after tax, right? Now, there are multiple views of profit. There are at least 5 of these that we have seen: gross profit, EBITDA, EBIT, EBT, and profit after tax, or net profit or net income for a company, right? Who looks at what, right? So if you're looking at a shareholder, the owner of the company, the owners want net profit at the end of it, right? If you're looking at the lenders are more worried about, does the company make enough profit before interest and taxes? Will they be able to pay my interest, right? If you're looking at specific unit heads, right, or operational heads, they are going to look at these two views of profit, COGS, the gross profit and the EBITDA, correct? So multiple people within the system of the company will look at all these multiple views of profits. And if you want to neutralize if you're comparing multiple companies, but you want to remove the difference in tax regime in India and Europe and US, then you use profit before tax as one of the key metrics, correct? So depending on who is trying to look at data, multiple views of profits become important. Obviously, you can derive the entire structure when you're creating the P&L statement. All of this will get created for the company, right? Let's move ahead and try and understand this concept of income and expense booking. So when exactly do you account for the sales, right? So if the business sells a particular item to the customer, that's when the sales is booked. When the vendor sells something to the business, that's when the expense is booked, right? So essentially, the the booking of revenue or expense has got nothing to do with when the money is received. It's more about when the ownership is transferred, right? So if I am producing this car and I give the ownership to the customer, regardless of whether the customer has paid me or not, I will incorporate this as a sale, right? When I'm buying some raw material from the vendor, regardless of whether I have paid the vendor or not, the moment ownership comes to my account, the expense is booked, right? Note that expenses for us are sales for the vendor. Who's the vendor? The supplier for us. The person who's going to supply our raw materials to us, that's our vendor, right? So when we have we have expenses, that's sales for them. Same concept of booking sales would apply for them. So essentially, the moment they transfer the raw material to us, that's taken care of, right? So essentially, remember very clearly that income and expense booking is happening when ownership is considered to be transferred, right? When the legal ownership of the product or service that you are selling is transferred to the customer, that's when you are saying the sale is booked. It is not necessary that the cash has come in by now. And that is what differentiates your business activity versus the cash activity. What happens if the customer pays after a year? There is a material change in the entire business financial health because of that, right? That we will capture when we look at the cash flow statement. When we understand that in more detail, that's where the cash flow idea would kind of come in, right? Let's look at a sample income statement. So we start with broadly what sales are. That's my revenue. This is the total value of goods that I have sold or services that I have sold. Now, there are some operational costs which are there. These are all the operational costs that come out. And I have manufacturing expenses, I have administrative expenses, I have sales and distribution expenses, right? Let's understand manufacturing expenses. Let's say I have a factory. The wages that go into that, the electricity that goes into that, the raw material that goes into that is all manufacturing expenses. Let's say I have, so this is all factory costs essentially. When I say factory cost, that's not the cost of the factory, but raw material cost and wages largely, and any kind of electricity, etc. Administrative costs are, let's say we have a corporate building, right? And this is only the head office of the company. The head office of the company. All expenses that happen there are under administrative expenses, right? Sales and distribution is going to be all your marketing expenses, advertising expenses, and so on and so forth. Then you get earnings before interest, tax, depreciation, and amortization. That gives you the operating profit, right? That's 1000 minus 600. That's going to give me 400. From this, I can remove the depreciation of 60. So what will be my EBIT? That's 340. From this, I can remove the interest of 60. So what will be my EBT or profit before tax, PBT? That's 280. On this, I apply a tax. The tax is 120. So my final net profit, which is what the owner's claim is there in the business, that is called as the net profit. That is 160, right? What is the lender's claim? This is the lender's claim. So this is the guy who has given us loan. This is the lender's claim. The interest component is going to be the claim of the lender for our business, right? That's the sample income statement that we are looking at. That's the premise of the income statement. In short, the income statement will tell us whether the business is profitable or not, right? On a business level, are you making money or not? That's the question that we are trying to answer. If you're comparing two companies on a business level, which company is making more money per rupee of sale is what we are trying to look at when we compare those statements, right? We will obviously look at this also in much more detail in one of the subsequent sections when we try and understand the premise of income statements with live data and some live companies data with in another section that follows, right? Let's then move ahead to discuss about a business model, right? And this is where the concept of retained earnings will come in now. So in the context of business model, let's say the company starts work. We run a company. Let's say we start a business, and this business takes a share capital of 1 lakh rupees, which is the owner's money that has been put in, right? When you start a business, that's your source of funds. And at this point of time, this will go and sit in your bank account. So it'll appear as cash. So that's my application of funds, right? They'll balance. So that's the balanced state. Now, let's say we use this cash and we buy some machinery, right? We buy some machinery worth 1 lakh rupees when we use this cash, right? Now that transaction will basically take out 1 lakh and put it towards a machinery account. So what we will see is that the business now is in this state. We have basically taken the share capital of 1 lakh rupees. That's my source of funds, and my assets, which is my application of funds, will take this 1 lakh rupees and put this in the fixed assets component, right? Now, let's say the business starts and we start generating money. We start generating first revenues and then we generate profits. Let's say at the end of the year, we have profits of 20,000 rupees. From the business that we're doing, we have a profit of 20,000 rupees that comes in, right? So what we are going to see is this scenario. We would have extra profit. That profit would come in the form of cash. We are assuming this money is received at this point of time. So that cash will appear here and it will increase by 20,000, right? Now this will not balance. This is not balancing at this point of time because we have not completed the balance sheet as such. There is a mistake in this balance sheet. The question is, if the company closes today, whose money is this, right? And if the answer to that is this is the money of the shareholder, then technically this 20,000 should be the claim of the shareholder. So either I can pay this 20,000 to the shareholder, to the shareholders, in which case we'll again go back to our 1 lakh and 1 lakh kind of a scenario. The payment that you make to the shareholder is called as dividends. That's called a dividend, right? So either I can pay 20,000 completely as dividend or I don't pay it. If I don't pay it, I have basically used this. I can use this 20,000 now for business. So in a way, this money is available with me, which means my shareholder will say that at a later point of time, they will take this money from us. In other words, this extra money has been added to our source of funds. Rather than taking the money back, the shareholder says you keep it, you run the business, you generate more profits. Next year, if there is a 30,000 rupee profit, we will see this number swell to something like 50,000, assuming they've not used the cash. If they've used the cash, fixed assets may have gone up, right? And this number here will go up to 50,000 as well, because if the company closes after the next year, then the total assets are worth 1,50,000, and essentially the total liability should be worth the same. That's the shareholder's money. The shareholder should get that money, correct? So practically speaking, whatever profit you generate, so if you look at share capital or shareholders equity of last year, right, plus the profit of this year, that should give me the total shareholders equity, right, which basically is going to get added to the retained earnings, or what is also called as reserves and surplus. Retained earnings are also called as reserves and surplus, and whatever extra money is left with the company that they have not given to the shareholders, that will come and sit under reserves and surplus, and that's an additive number. So every year the share capital plus reserves and surplus of year 1 plus the profit of year 1 are going to give me the share capital and reserves and surplus of year 2, right? That's how it is going to continue. So if I make 30,000 profit next year, that 30,000 goes and sits in retained earnings. I keep adding that. If, however, I repay something, I pay some amount out as dividend, right? Let's take the scenario where out of this 20,000, 10,000 was paid as dividend. So then the equation would have been share capital of 1 lakh, reserves and surplus or retained earnings of 10,000, because 10,000 is left now. You would have cash of 10,000 on the other side, and you would have fixed assets of 1 lakh, right? This is a very simple hypothetical company that we're looking at, and that would be the scenario of the company's business. In which case, what we are basically saying that if you have paid something out as dividend, you have to remove that from your overall equation. So last year share capital plus last year reserves and surplus plus the profit you made this year minus any dividend you paid this year is going to give us the share capital and reserves and surplus for the next year. Let's do this calculation. So this is 1 lakh and I started with 0 here. The profit is 20,000. If I don't give a dividend, this will become 1 lakh plus 20,000 on the right hand side as well. If I give a dividend, which is 10,000, then it will subtract 10,000 from that as well, because that is the shareholder's money and you have already given that money to the shareholder. The moment you give the money to the shareholder, that is no longer a claim on the company, and hence it is no longer a liability for the company. You have paid the money, correct? So that's how you kind of create what is called as the statement of retained earnings. When you build the retained earnings statement, you're taking the profits you have created, you're removing any dividends that have been paid out, and what is left in the company is considered as retained by the company for further usage, and that goes and sits here under the liability because it additionally generates a source of funds for the company, correct? So that's my business model. And as we come to the close of this section, just a couple of questions. What does the P&L statement tell us? Describe any two views of the profits that we have seen in multiple views and multiple definitions of profit that we see. And what do we mean by retained earnings? Thank you.